VC funds have got a legal obligation to report regularly to the LPs on the value of the underlying portfolio. They have to do some form of valuation as to what the market value of each underlying investment in the portfolio is at a specific point in time. Now, this exercise is pretty simple for asset managers who invest in listed financial assets like shares or bonds. It's a bit more complicated with the venture fund because being unlisted, the shares in the underlying portfolio companies don't have a transparent and readily available spot market price. So doing traditional mark-to-market valuation is impossible. So VC funds, in compliance with International Financial Reporting Standards or GAAP, will apply the valuation method they assess to be the most suitable for the underlying portfolio of investments so that they can fulfill their reporting obligations. There are three main valuation methods that are applied. What's called last round valuation. The second is a comparable company analysis. And lastly, there's the option pricing model. Let's start off with the last round valuation. Some venture firms will value their companies by taking the last round valuation in the private markets. They'll base the value of their stake in the portfolio company on this valuation. So for example, if at the last valuation, a company in the venture fund's portfolio was valued at $200 million and the VC had a 10% stake in that company, then the VC stake would be reported as 20 million. The next type of valuation is what we call the comparable company analysis. Now, this method of valuation involves valuing a company in a fund's portfolio based on comparing it to listed companies in the same industry and that have a similar business model. It's really most relevant where the investee company has managed to get to a stage where it generates significant revenue or profits. To value the investment in the venture fund, they'll select a valuation metric. This could often be a revenue multiple. A revenue multiple just measures the value of a business relative to the revenue it generates. Other things remaining equal, companies that trade on low revenue multiples are viewed as cheap relative to those who trade on higher revenue multiples. Now, the chosen valuation metric will then be applied to the portfolio company. Other factors that may also be considered in arriving at the final valuation could include things like the number of customers or subscribers and even the website hits the company has. Let's do an example again. If a portfolio company is generating 200 million in revenue and similar listed companies are trading at 5 times their revenue, then the value of the portfolio company would be 1 billion. If the VC firm held 10% of the company, then the initial indicative value of its stake could be around 100 million. Often, the VC firm would then apply a discount for the lack of liquidity or marketability because the shares aren't listed and they can't be freely traded like those of comparable listed companies. If the lack of liquidity discount was, say, 20%, then the value of the VC stake would be around 80 million. The last valuation method is the option pricing model. Now, the option pricing model is probably the newest valuation method that's being used to value venture capital portfolios. It's a bit of a complicated, mathematically driven model that uses Black-Scholes options. And it values a portfolio company based on a set of call options whose strike prices are the different valuation points at which employee options and preference shares convert into ordinary shares. The method is very complicated. This isn't the place to unpack it in detail. But it's important for you to know that it's being applied more frequently, especially when a company has raised Series C and beyond funding. So what are the implications of each of these methods on what a company's value is? Let's do a quick example to show how the valuation method influences the value. Assume that the venture fund has invested 20 million for 10% stake in a portfolio company. Now that company has just raised fresh capital, valuing it at 7.6 billion. Using the last round valuation, the value of the venture fund stake would be 760 million. That's just 10% of the 7.6 billion valuation. So the initial 20 million investment has yielded a return of 38 times as things stand. Now, using the comparable company analysis method, let's assume the investee company is forecast to generate 260 million in revenue in the current year. And looking at companies in the same industry with a similar business model that are listed, these are trading on a revenue multiple of 10. That would give us a provisional value of 2.6 billion. After factoring in a 30% liquidity and marketability discount, our final valuation for the entire company would be 1.82 billion, and the fund's 10% stake would be valued at 182 million. That indicates a return of just over 9 times. That's pretty good, but it's way off the 38 times when we applied the last round valuation. If we applied the options pricing model to the same company, we would arrive at a valuation of about 320 million for the venture fund's 10% stake. That's 16 times return. The point I'm trying to make is that based on the valuation method used, different returns and different valuations are going to be reflected in the reports to the LPs.